Well, welcome to episode 18, and today you just get me, Ryan. Bryon's been out sick the last couple weeks with COVID, and, well, you get me. I'm just going to do a little quick update in the market and what I think is going to happen and what I've seen happening. I feel like I do a pretty good job of following the markets, and I listen to a few different gurus, and, there's so many people out there right now that are talking and so many different things that people are saying. I remember last year there was an economist that came out and said, oh, there's going to be 6 Fed cuts next year. Well, guess what? That's just speculation. Moving into this year, the Feds, right before this year, the Fed said that there might be 4 Fed cuts. And then January meeting came and they said, that's probably a little ambitious. There still might be 4, but we're going to kind of move them back into March. Now we're in March, and the Fed cuts are looking to be extended longer and longer and longer before they actually cut. Right now we're actually looking, I don't think we'll have a cut until sometime in the summer, maybe even late summer, September. We'll see. All they do is look at the numbers. The biggest thing that right now that they're trying to fix is not fix, but control is inflation. And their number one thing is the PCE. And that has been higher than what they want. They want it down at 2%, and it's been hovering around 2.6 to 2.8. It has been coming down, which is a good thing. But until that gets down to 2%, the Feds aren't going to cut rates. And realistically, when the Feds cut rates, what are long-term rates going to do like mortgages? They might not move much because they aren't attached to the Fed's fund rate. Let's talk about that real quick. Mortgage-backed securities are the only thing that affect mortgage rates. A lot of people don't know that. It's not the 10-year T-note. It's not the Fed's fund rate. It's mortgage-backed securities in the bond market. And what affects bonds the most? Inflation, employment, those types of things. The Fed continues to watch this, and as inflation gets better, yes, bonds are they're a safe haven, so people put money there, and when people put money into the bonds, that's when rates come down. For example, at the end of last year, October 19th was the highest rates we've had, and from October 19th to the end of December, the interest rate for a 30-year fix fell almost 1.25 points, but the Feds didn't do anything. That's kind of the inverse cycle of what people don't understand. What will happen in the future? I don't know. I don't have a crystal ball. I definitely think rates are going to come down. When that happens, I don't know. It's just going to be up to the Feds and how they look at inflation and the jobs and the whole economy. So if you have questions, give me a call. Give Bryon a call. Today, it's another great day. We'll talk to you soon.